The Federal Reserve is front and center right now. We need to discuss what's happening and what's about to happen right here in this video. We'll get to what the Fed will do. The second thing is what is the impact of their actions. And number three is what happened before. I'm going to show you the historical context here so that you are well informed. Let's begin. If you stick with me throughout this video, I'm going to explain what you need to know as an investor or even just an individual who's concerned about their house, their mortgage, the bills that they have to pay, and so on. I'll give you everything you need to know. Let's begin right here. Inflation is making pizza more appealing this Thanksgiving. Of course, people have had to change their basic needs. They have had to look at what they spend their money on because no longer is it a simple matter of, don't worry about it, a few bucks here, a few bucks there. Now people are pushed to the edge. And at this time right here, you can see that we've gone through these inflationary cycles before, but what's different? You know, in the 1970s, one income could afford a nice, decent home for the family. But that is not the case today. People are pushed to the edge in terms of debt, and we look at what had happened all throughout this period. Inflation may have come down year over year, but the prices that we have paid, that has not been the case, okay? It is extreme to say the least. So you can look at this data right here that I'll show you, and it starts to make a lot of sense. Inflation soars over 300% in Venezuela. Now this is an extreme example. Venezuela is not the US is not Venezuela. But when you have issues that go on, and of course there's corruption, there's external factors, there's problems on every level, okay? Like I said, US not Venezuela. However, when we get extreme circumstances, we do end up with extreme results. And of course, this is just one example of that. We can look at Zimbabwe, we can look at all these different countries that have happened historically or even today. Look at Iran that has a hyperinflation at this time. All of these different places end up in a spiral down and cannot resolve their currency crises. So when we get too far, you can't pull it back. Now, here we go. I wanted to show you what's happening right now with the Federal Reserve. The Fed is expected to raise interest rates by 3/4 of a point and then signal it could slow the pace. That is my base case. When I look at the details, it's pretty clear to me that the Federal Reserve is most likely to increase by 75 basis points or 0.75% at this meeting. And as I record this, you might be watching it after the meeting actually follows. And I'm going to give you all the details of what happened afterwards, of course. But that's the base case. If they go to a 50 basis point, oh my goodness, the markets are going to fly. They're going to fly. If they actually suggest that after this 75 basis point, the most likely will be something lower than that, which is probably what they're going to do. Again, base case, that this is going to actually pacify the markets and make sure that they're, A-okay taken care of. We'll talk more about that at the end of this episode when we break it down. Here we have it. The Federal Reserve is expected to raise rates by 75 basis points, signaling a slowdown of its rate hikes in December. Markets also braced for the Fed to end hikes in March at a level of 5%. A 5% Fed funds rate, to me, that would seem to be quite devastating, to say the least. Now, this is Jerome Powell. As you've heard him being quoted before, I wanted to bring it up right here because it's relevant. Back at the September 21st press conference, he told reporters that restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. He repeated this over and over and over again. As they say at the bottom of the page here, this is what I actually showed you in the charts of that particular event that happened. I gave you all the data right after it came out. And essentially, they suggest that unemployment will rise to 4.4% by the end of 2023, and then that's it. No higher than 4.4% as a result of all of their tightening. Now, I'm not sure what's going to happen, but 4.4% is still historically super low. Now, why would he say that? Well, according to the statistics right now today, the job openings, which I'll get into in a sec, are just skyrocketing. No matter what the Federal Reserve does, job openings are really, really abundant today. Maybe it's not the jobs that people want necessarily, but they're there, and you have millions and millions of them. So that is quite intense. Look here. US job openings post surprise increase, keeping pressure on the Fed. Vacancies climb by 437,000 to 10.7 million in September. Quits rate held at 2.7%, while number of hires eased. So you can look at these numbers. It's all broken down, of course. I think it's important just to suggest that the Federal Reserve looks at all these different figures to determine what they're going to do with interest rates. And of course, if the labor market's in this position, they really don't have an excuse, right? I mean, they've got to look at this. Unemployment is near a historic low right now. What are they going to do? This is what happens when the Federal Reserve increases interest rates. I'm showing you the history right here. Stocks go sideways for the first 6 months after the last Fed hike. Now, of course, you don't know which hike is going to be the last one at that given moment, but this is just mapped out on this chart right here. The blue line is the median S&P move around the last Fed hike back to 1970, and the gray area is the 20th to 80th percentile. So it's kind of an average range of what the expectation is. And so you can see that there will be turbulence around the time that they are hiking interest rates as the markets kind of feel it out. And then we have a breakout afterwards. So if they're still hiking at this point, and by the way, historically, you look at it, the Federal Reserve hikes interest rates, stocks don't go up. Now, there could be outliers. There could be individual stocks that do well. But in general, the markets don't move higher when interest rates move higher. Okay? They might not necessarily go down, but they don't really just go up, okay? Because the tightening, you have earnings that are affected by this, and the markets do not like it in general. Here you have it, the performance of the S&P 500 before and after midterm elections since 1946. The S&P 500 has always been higher 1 year after the vote. So we've got that going on right now, and I think it's important for people to see this. It's just anecdotal evidence. I wouldn't really take this and put all my money onto it, but that's just food for thought. Now, this is a chart that basically shows us all the different signposts, the possible warnings, the flags, the indicators of a recession, of a bear market. There are only 2 of these indicators today suggesting that we are at the bottom. And if you look at the others historically, it just shows us that there could be more turbulence ahead. That's all I'm trying to show you here in this chart. You could pause it, you could download this. The links are in the description under the sources. But I don't really put too much weight on it because each and every cycle is always different. And then you got to look at the nuances behind it. Maybe something had happened before, and the 2 years leading up to it is this event or that event. But it just gives you a little context that when you compare it on these different indicators, it's just some interesting information, to say the least. If you look around the world, we have a lot of the same patterns appearing. Inflation in the UK shops rises to the highest level on record. Now, I was looking for this article here, and I found that repeatedly this exact same title was just coming up month after month after month. So we are experiencing something right now with the UK inflation rising higher and higher, and that puts an impact on the stores, on the shops, on the businesses, because they're seeing their prices elevating to levels. You know, you as the individual, maybe you can put on an extra sweater instead of turning on the heat. But if they're making food or they have to, as part of their business, they can't do away with it. They can't just turn that off unless they want to shut their business down. And for so many, that's unfortunately what has occurred, not just in the UK, but elsewhere too. Food price increases hit 11.6%. That's another record, with tea bags, milk, sugar, all experiencing significant hikes. The challenging economic conditions are significantly impacting consumer confidence and retail spend. It's the same thing in the United States and other places where the consumers are starting to say, maybe now's not the good time to buy that or this. And of course, that has an impact. Korean inflation picks up, boosting case for more tightening. They have not gone through this cycle yet, and you're going to see this in different countries. This happens to be just one of those. Are they going to do a 50 basis point, or are they going to do a 25? Well, of course, if you've got inflation picking up or it's not slowing down as fast as you need it to, well then, you've got to go hard. But they don't want to do that. We have this. I thought this was hilarious. For anybody that's been on this channel for a while or read my books, you know what's going on with Japan, that they have printed an enormous amount of money, of cash, of currency over these years, decades in fact, and they've made a big mistake because they can't turn this off now. And the suggestion here, they're trying to figure like an exit plan, like what are we going to do with all this garbage? We've been buying all the ETFs, we're the only buyer left. It's a ghost town. Okay, and they're coming up with all these different plans. I just thought it was hilarious. Japan Central Bank should swap its exchange-traded fund holdings for perpetual bonds. Perpetual bonds, my goodness. Oh my goodness, I almost fell flat on my face when I read that earlier. Anyway, to ensure that an eventual exit from the stimulus doesn't upend equities. What a joke. You can't exit, okay? Do I need to say that? Do I really need to say that? You cannot exit Japan. It's not going to happen. Just admit that what you did was wrong and that you'll fix it. You're going to try, but what you're doing isn't the resolution. All eyes are on the Fed today. And of course, you look at their activities, everybody's watching them, okay? They must carefully balance a tough stance on inflation, but that they will ease up soon enough. Oh yeah, we're real tough on inflation, but shh, we're gonna take care of you soon enough. Don't worry. Markets believe that the Fed will not disappoint. And we have seen that since October. The markets had bottomed out and started to rise with this belief that it's not gonna go anywhere. Don't worry about it. You need to buy the dip. Some of the biggest companies in the world, like Amazon and Meta, Facebook, have seen their stock's value cut in half or more. Just imagine that. This is not some penny stock that you would expect, okay, I lost, no big deal. We're talking about some of literally the biggest companies in the world. Remember the FANG stocks? Big difference today, isn't it? Half the value or more. Understand that most very large companies are going to disappoint. Yes, you heard me correctly. And that a few outliers generally outperform at any given time. And that carries the index forward. It's not as if Amazon is going to be the best performing stock forever. It's not the way it works. Look at this. We are right now for Amazon, and which, by the way, is right there. Amazon 2018. The level we see today is the same from 2018. So what does that mean? 4 years now, no growth. Of course, there might be a time in which it does go way past this. So some people buy in now saying, hey, I'm going to buy the dip. But we got to understand the way it works. And, I think for a lot of people, I think I have to do a video entirely about this. Okay, I made a post about it on the community blog section of the channel if you haven't seen it already. But I think I'll expand on that in a future video. Stay tuned. Have cash flow assets that pay you while you're waiting for the appreciation. So if you look at a stock that has a dividend, if it's not doing well for a long period of time, at least it's been paying you, even if it's a small amount. You're collecting that cash. A lot of people, they take it and they reinvest that. You should be taking that and diversifying with it. You should be putting that somewhere properly. Look, cash flow assets, there's many different types, but I think it's important for people to understand that diversification is not what the Warren Buffett quote and all this nonsense. No. That's not diversification. Please understand real, true diversification. I've talked about it in previous videos. And if you ask me, I will talk about it in a future one as well. Listen, what do you think about this video? Was it informative? Of course, you loved it. All right, yeah. So you're going to hit that subscribe button down below. I'll see you tomorrow.